dropped everything and let you know what's going on in the world of mortgages. More rules come from Ottawa this morning that will take effect at the end of this year. And I'm just going to take a few seconds here using some fancy-dancy technology to explain to you what those changes are and how they may impact the Canadian consumer. So one moment, please. On January 1st, 2018, all mortgage borrowers are going to be subjected to what's called a stress test. This is exactly or very similar to what I was describing last fall when that stress test was implemented to people who were putting down less than 20% in purchasing a home. This stress test is now going to be applicable to all people across the borrowing spectrum. Whether you're putting down 5%, 20%, 35%, 50%, or 70%, everyone is going to be subjected to this stress test. And because they're now going to be affecting the conventional or uninsured borrower, it's going to be affecting all rate types. Those of you who have borrowed using a variable mortgage in the past know that you've been subjected to a little bit of a stress test before. The stress test now applies to fixed and variable rate mortgages. Because it's going to be impacting conventional or more than 20% down borrowers, it's going to affect all amortization, so not just 25, that being the maximum for insured borrowers, but 30 and 35-year AMs as well. And if you in fact are in a position where you're purchasing a home with a reduced amortization, maybe even 10 years, you want to get out of debt even quicker, you will still be subjected to this test. So what is the stress test? It's where we use not the rate that's being offered to you, but a much higher rate in order to determine your ability to withstand the eventuality of higher rates. What we're going to do is we're going to qualify you using either benchmark, the benchmark rate, which is currently 4.89% across Canada, across all federally regulated lenders, or we take the rates that's been offered to you for your mortgage and we add 200 basis points or 2 percentage points in order to simulate the stress test that way. And the way this is going to go down is going to be whichever is higher. So it's going to be 489 or your rate plus 2%, whichever is higher. So here's a real life example. I've got two clients who are ready to buy conventionally, and that means they're going to put more than 20% down. They're uninsured mortgage purchasers. So they're looking for a 5-year fixed rate. They're going to go for a 30-year amortization because since they're going more than 20% down, they can stretch their amortization out to that length. And they have $160,000 down from the sale of another property. So they're in a good position equity-wise. So today, October 17, 2017, the best 5-year fixed uninsured or conventional rate I can get them at a 30-year amortization is 3.09%. I'm going to qualify them using 3.09% as the qualifying rate. And I'll take their entire financial profile into account, their income, their debt servicing, their liabilities, their credit profile, etc., etc. And using this math, I determine that their approximate borrowing power today is $627,500. I throw in that $160,000 down payment that they have available. That becomes what is now 20.3% of an overall purchase price of $787,500. Cool. Fast forward to January 1st, 2018. Happy New Year. 5-year fixed for the sake of argument. I don't know what the rates will be then, but let's just say the rates have not even moved and they're still 3.09%. What I now have to do under the new guidelines is qualify you at the rate being offered to you plus 200 basis points or plus 2 percentage points. So I have to qualify you as if the mortgage rate is 509. How does that look? I take the same math, the same financial profile of those borrowers, and I arrive at borrowing power that has now been reduced to $490,000. We tack on that down payment, and it's now 24.6%, but it's 24.6% of what is now reduced purchase of $650,000. So what does that mean? Well, today, the people that are qualified or pre-qualified to purchase a home for approximately $787,500, on January 1st, all other things being equal, they'll be good for only $650,000. So this is a reduction of $137,500 in this case, or approximately 17.5%. Why is this happening? Federally mandated because of some prevailing policies and beliefs. First of all, there's no doubt this is a rising rate environment. If you've been following mortgage rates for the last 6 months, you know that rates have been marching up steadily in lockstep with the Canadian economy's improvement. So prime rate has gone up a couple of times here since July. Fixed rates have been marching up too. So it is a prudent move in that sense for the Canadian government to be implementing a policy like this to prepare Canadians for the eventuality of rising rates at the end of, let's just say, their first term at these rates. Then we've got these overall concerns about household debt levels. They are at all-time highs, and the ministry all the way down to OFSI, those departments that prevail upon these changes have been expressing those concerns. Then there is the overall concern about the housing market, and that's been, of course, the subject of all kinds of conversation. I don't need to get into those details, but it's believed that this historically low-rate environment has contributed to a red-hot housing market across Canada. So there you have it. That's my message for the day. Just wanted to pass that along to you. If there's any questions that you have, I think this is important stuff. It's going to impact people who happen not to be purchasing or refinancing a home between now and the end of 2017. So if you know anyone, such as your realtor or a friend or someone else who may be impacted by these changes in the interim or next year, by all means share this video. Talk to your mortgage advisor or your banker and find out more details about these rules as they roll out. Thank you, and have a good day.